Good evening, everyone. So this is the first lecture of management. This is one of your course subjects, and before we start, I'll just give a brief introduction. My name is Iyer. I am an MBA graduate from the triple accredited Bradford School of Management in the UK. I have 22 years of experience, including 19 plus years of corporate experience with established organization and startups. I've been a part of US and UK based campaigns and have managed leadership teams across locations in India and the Philippines. I've led cross-functional teams, and on the whole, I've been responsible for client satisfaction, people satisfaction, revenue satisfaction, and my core deliverables have been service delivery, strategy and execution, client engagement, people succession planning, and P&L management. So that's in a nutshell about me, and management as a subject is very, very interesting. It has evolved over a period of the last 2 decades, and considering the recent developments that we see in the economy and corporate world on the Indian and the global front, I think it's a evolving concept, or it's an evolving subject, and a lot depends on how we adapt to the changing situations or the changing dynamics of business and the macro environment in general. I'm sure most of you guys are working professionals, and you come across the term management, right? So management has various connotations. To some people, management is the team, the top team, which manages affairs in your organizations. For some people, management is basically getting things done or getting the work done. For some, management is basically management of people. So there is no one shoe fits all definition for management, because it depends context to context. Now, while there are a lot of textual definitions of management, I'm sure that you are in a position where you're able to reflect your day-to-day experience, your own context, and see what management is for you and what value you derive out of the management subject. So it's dynamic in nature. I think the first thing, I mean, to me, if you look at your textbook, so going through the textbook is one part of the journey, right? Where you will have definitions. You can always go back to those definitions, to those concepts, if you want to refer to. But what will really help as we move along the course is reflect on what we study and try and relate to your scenario, or evolve those concepts that you study, and keep reading about those concepts, and keep looking at practical examples or queries that you have, ask queries that you have from your day-to-day jobs. Okay, so if you look at your textbook, right? If you look at your textbook, I have a copy of the textbook open here. Now, if I look at it, it is the basic introduction to management. Then you have, so that's what we're going to cover today. And then there's another concept of stewardship and agency theory. So these are the two things that I'm going to dwell on today, right, in details. So you can refer to your textbook, your first page. It starts with so basically, see, management, if you look at what management is, we're going to do a blend of free explanation and also reading from the text, right? So in simple context, management provides leadership to a business enterprise, right? It is the core of leadership, and which is absolutely critical in a ever-changing competitive environment. And you must have read a lot these days. There are a lot of articles which emphasize on the quality and performance of managers, and talent being a key differentiator for organizations and companies to drive sustainable performance. So managers are planners, organizational planners, organizers, leaders, and controllers. So that's the conventional definition of management. I mean, in simple words, if you want to see what management is, if you look at your organization or you look at your setup, management is all about planning, organizing, and leading and controlling to achieve objectives or outcomes which are sustainable and successful, right? So let me just read a bit from the text now. So as the name suggests, it's related with managing other men tactfully to achieve some predetermined goals. In every walk of life, management has its own applications since to achieve certain goals in an organized manner, adherence to basic principles of management. From the theories of economics, it was apparent that one out of our four factors of production, the last but not the least factor is entrepreneurship, which is nothing but organizing skill, administrative ability, and enterprising initiative of the management. Thus, and as I mentioned, so I'll simplify this. So you have heard about the factors or inputs of production, right? Land, labor, capital, and entrepreneur. So this touches the entrepreneur aspect of it, right? Where as I discussed earlier, it provides leadership. It is leadership to the business enterprise. Okay. Without able managers and effective managerial leadership, the resources of production remain merely resources and never become production. Under competitive economy and ever-changing environment, the quality and performance of managers determine both survival as well as success of any business enterprise. Organizations must acquire and allocate the resources necessary to achieve their goals. However, successfully an organization achieve its goals, objectives, satisfies social responsibility, or both depends to a large extent on its managers. If managers do their jobs well, the organization will probably achieve its goals. Managers at every level plan, organize, lead, and control the organizations. Managers may be called as organizational planners, organizers, leaders, and controllers. Managers are in constant action. So as we discussed some time back, it's basically the quality and talent and performance of your management team or your managers, which is going to be the key for business outcomes, which is going to be the key for consistent goal attainment, and in an ever-changing economy. That is what we discussed a while ago, right? We spoke a while ago that if you look at the business dynamics around you, a lot of things are changing. People are talking about artificial intelligence, people are talking about offshoring, people are talking about succession planning. Now, if you consider these business dynamics, it's your management team or your managers who are going to be the key to drive performance. And I'm sure, in your own roles or in your own organizations, you have managers you look up to, or you refer to, or you talk about, or whom you talk about. But of course, you are working in close coordination with these managers to attain your business objectives. Okay, virtually every study of managers in action has found that they switch frequently from task to task, changing their focus of attention to respond to issues as they arise and engaging in a large volume of tasks of short duration. Mintzberg observed CEOs on the job to get some ideas of what they do and how they spend their time. He found, for instance, that they average 36 written and 16 verbal contacts per day, almost every one of them dealing with a distinct or different issue. Most of these activities were brief, lasting less than 9 minutes. Cotter studied a number of successful general managers over a 5-year period and found that they spend most of their time with others, including subordinates, their bosses, and numerous people from outside the organization. Cotter's study found that the average manager spent 25% of his time working alone, and that time was spent largely at home, on airlines, or commuting. Few of them spent less than 70% of their time with others and spent up to 90% of their work time this way. So what this essentially means is, and see, this might not be applicable to all organizations or all industries or all nations for that matter, because see, we're talking about researches being done in 1973 and 1990, and in all probability this could be a very pro-Western survey which could have happened, right? But essentially what it means is managers are always in action. Okay, there's a phrase called firefighting to do with managing day-to-day operations or routine operations. So basically they switch tasks, and what Mintzberg essentially identified is that most of the managers, they spend time with others, right, or with their teams, or with their stakeholders, with their bosses, or in meetings, rather than spending time on their own activities. It clearly says that 25% of the time is when they spend on themselves, on activities that is needed for themselves, for their own work, basically, right? Most of the other time is spent in coordinating or collaborating with teams and with stakeholders. Moving on. So management is a distinct function, right? Management basically came into the fore, or it attained that limelight, I think, post World War II. That's what the text says here, right? Post World War II is when it came into existence, or it got that prominence because of the World War II. So management is not only in the organizational context, it's also in the social context, right? So you have management at your house, for that matter, right? And you have management in sports. So basically it's the American way of manufacturing, in the early eras, I mean, of post World War II, which triggered the interest in management. And that's how a person called Stafford Cripps, he was basically Chancellor of the Exchequer in UK, and this was post World War II. So he basically was intrigued by the concept of management, and he was kind of impressed by the American style of management because of the success that American manufacturing companies had seen, right? So what he did is he studied the subject extensively, and that's how he sort of created exchange programs for the British and American teams. So he piloted the concept of productivity, individual productivity, business productivity, and organizational productivity, and he was influenced by the American style of management. So there were exchange programs between the British and the US teams, and the Marshall Plan came into play. So the Marshall Plan was basically for social and economic restructuring post the World War II, and that's how you do. This was a very systematic approach from Cripps, basis what he saw and what he learned from the US manufacturing, and that's how the Marshall Plan came into play in Britain for the social and economic upheaval. So the plan saw a lot of success, and post the success of this plan, this implementation is when management really became a talking point to an extent that it was discussed by one and all, right? And if you see, other countries also started adopting management as a concept. So the Japanese, they had gone through a major economic loss post the World War II. You're aware of that, and they laid out a structural, decisive plan for their economic revival, for the country's economic revival, and they adopted the concept of management. Then you had newly independent countries in India and Africa and also Southeast Asia who started adopting the concept of management, and you would have heard about the Asian factories. Now I'm referring to countries such as Japan and Taiwan. In the early 70s, they could successfully implement the management principles and practices, and they could bring about a turnaround in their economies, so much so that they became the manufacturing hubs for the globe. Also, a lot of Southeast Asian nations also adopted management. What started happening is people, institutions were established in these countries, in these developing countries, and also colleges and universities were established to study management at depth and see the impact management could have to independent nations and economies. So there are lots of definitions of management, and the book has a lot of definitions, in fact more than enough. You are more than welcome to go through all the definitions that we have, but particularly what sums up is basically I would just go through a few. What basically appealed to me if I look at these definitions is are these few. It's basically, as Aga Hasan Abedi says, it's getting work done through people, but real management is developing people through work, right? So it's not only about getting work done, but also getting people ready or molding them or grooming them to take on bigger roles and bigger challenges. And that's why increasingly these days, if you relate this concept to management or to your organization, you would have heard a lot about succession planning or grooming or these leadership programs that we have in place, which is also a differentiator these days. If you look at it, people talk about the trainings that are given to managers and upcoming managers, and people talk about the investment that is done in training. And probably if you look at this definition, it's way ahead of time. Basically it's setting the direction or setting the tone. Okay. Lawrence aptly says management is the development of people again and not the direction of things. So it's not only getting things done, right? It's also about how your people are able to do things moving forward and how it impacts your people, which is going to be a critical element for organizations, right? George R. Terry, management is a distinct process, consists of planning, organizing, actuating, and controlling performance. It should be performance, not performed. Looks like a typo. To determine and accomplish the objectives by the use of people and resources. So if you want to go by a very textbook conventional definition, if you pick up any MBA student and you ask him or her what is management, this is the definition which will definitely come out, because it's about planning, organizing your resources. Now in the erstwhile, so this definition is more from an industrial era context, where there were factories, there were assembly lines, production of various things. But if you look at the overall context, even if I apply services, it does entail your planning, your organizing, your actuating, which is basically your implementing, and controlling performance to determine and accomplish the objectives by use of people and resources. So basically you have to use your people and resources. In a manufacturing context, resources would be raw material. People would be more apt from a services context, right? Now, if you look at it, India is more of a service-driven economy, right? 54% of our people are into services. Although there is lots to go in terms of moving from an agrarian economy to a services economy, right? And so I think this is also a very apt definition of management. I move on to Henry Fayol. He's one of the accomplished management gurus. He says to manage is to forecast and to plan, to organize, to command and to coordinate and to control. So you see this plan and organize and control is a constant. It's about planning, organizing, controlling. Direction, some people say it's direction, some people say it's commanding, right? But it's all about your end-to-end planning, controlling, execution of things or of initiatives or of activities. I'm sure you would have heard of Peter Drucker. He's a well-renowned, accomplished management guru, and he's so much so that he's called the father of management. So he says management is a multi-purpose organ that manages a business and manages managers and manages, worker and work. So basically this is a very well-rounded definition, because he talks about your managing the business, the enterprise, the business, the managers, the workers and the work, right? So all cogs in the wheel are covered here. So it's basically managing anything and everything in an entity to drive results or to accomplish objectives. Okay, moving on to page 3, there are more definitions there, and I am not sure how much of these definitions would you want to cover, but basically if you look at it, the crux of it is basically management is a technique of extracting work from others in an integrated and coordinated manner for realizing the specific objectives through productive use of material resources. Right. So again, it's an end-to-end process. It's an integration because a lot of factors are into play, and it is for realizing specific objectives, meaning it's outcome driven. Mobilizing the physical, human and financial resources and planning the utilization for business operations in such a manner as to reach the defined goals can be referred to as management. If the views of various authorities are combined, management could be defined as a distinct ongoing process of allocating inputs of an organization, human and economic resources, by typical managerial functions, planning, organizing, directing and controlling, for the purpose of achieving stated objectives, namely output of goods and services desired by its customers' environment. In the process, work is performed with and through personnel of the organization in an ever-changing business environment. So they have broken up this definition in a way where they're saying it's about planning, it's about utilizing your resources, be it people, be it raw materials, be it other inputs. Now again, it depends on the, let's say for Swiggy, one of the inputs or raw materials would be your vehicles, your fleet management, right? Because they have to deal with deliveries. Now, you plan, you organize, you direct and control. So that's basically a managerial function. And what they've done here is they've given a different flavor to the definition by aligning this definition to the client objectives. That's the environment, because ultimately what every business would have clients, internal and external clients. And more often than not, what you're doing is you're doing stuff to get client satisfaction. Yeah. So work is performed with and through personnel of organization in an ever-changing business environment. So basically, they have again touched upon the people aspect. Where they're saying that people are the key. You need to work with people, and they have stressed on the ever-changing business environment, right? Because a lot has changed for a lot of businesses since COVID. And there have been times, even today, people are talking of automation. There are a lot of opportunities where work can be automated. The entire work stream might change. There are a lot of talks. So basically, it's going to be your people who are going to be the key to this changing and evolving business environment. So moving on. So nature of management, right? So we spoke about your, we spoke about management, we spoke about the definitions of management, right? And basically the nature of management, it is result oriented. It is result orientation, right? So basically anything, you have management or you have certain objectives that need to be met. So all these resources, all these people come together to attain certain objectives. It's not, you must have heard, at least I have heard in my associations, my boss is telling me that we are not doing charity, right? So for some it's P&L, for some it's sales, for some it's revenue. So all these things need to lead to an outcome or a result, and that's one of the nature or key essence why management is into play. A humane approach, So basically it is a set of activities you perform with or you perform through people. That's one of the definitions that we had gone through earlier. So you have to have humans involved in this entire uh, you know jigsaw puzzle, I would say, or activities, because it it entails coordination, cooperation, partnership, and all these so-called fancy adjectives will be achieved only with and through people. So management is process centric, meaning it's not just anything and everything. It's just not that you do what you want. There is a process that you rely on, that you adhere to. Correct. Uh, these are defined processes that you follow, and obviously the processes lead to outcomes. Okay. It's universal, meaning management is not only applicable. So the word management is, if you look at it broadly, it's as simple as managing, right? So it is not only from your corporate context, but if you look at it socially, it is social management. So if you don't have to go beyond, just look at your house. Your mother, your wives, your husbands, okay, they are managers. They manage things. We talk about political management, right? So there's a political landscape. So these political parties, they have to be managed. Social management, you have to manage social quotients. I mean, governments do a lot of management. You also have sports management, right? So basically you have teams which are being managed by coaches, psychiatrists, so on and so forth. So management is universal and it's applicable to all fields. Required where, okay, so basically it is required wherever there is a group or wherever group effort is involved. And what's a group? Anything more than one is a group, right? Plural, two or more is plural. So basically a group can be two, a group can be three. So wherever it is not individual effort, you need management. Okay, it's a science as well as an art. Management is a science as well as an art. Now this thing is repeated in your notes. It should be once. I think it's there twice. So basically it is basically one of the oldest art, that's what people say, and the newest science. Now management involves, now we will discuss this in detail, but just to in a nutshell, management also is like a science. It relies on facts, processes, is outcome driven, and like an art, it is also creative. It is creative, it is subjected to context. So all these factors make it an art. I will cover this in detail in the next few slides, or in the subsequent few minutes that we have. Okay, so it's a system of authority. So basically so in your own organizations there's a hierarchy, right? So let's say you're a financial, so your financial controller approves budgets, or your CFO approves certain budgets or capital expenditure. It's not anyone and everyone who can just get up and approve a budget, right? So you have a system or a hierarchy, and that's in place to ensure that the management is seamless, right? So you talk about approvals, talk about decision making. There has to be a chain, right? People are given the freedom to make decisions at various levels, but there is one person, or there are certain individuals who make key decisions, and that's as per the hierarchy. And that's why it's a very common phrase you would have heard, whose neck is on the line. Okay, management involves decision making. Okay, so obviously that's the key. You might collaborate, you might work with people, through people, but at the end of the day, decisions have to be taken which will lead to outcomes and objectives, attainment of objectives. Management implies good leadership. Okay, so we all have various definitions or ways of looking at good leaders. I'm sure if I throw this question up: which leader or leaders you guys admire the most? I'm sure there would be a laundry list which would come out, because each one of us has a different way or a unique way to look at leaders. For us, some of us, maybe, maybe a Narayan Murthy is a very good leader. For some of us, maybe a Mahendra Singh Dhoni is a very good leader, right? For some of us, maybe let's say Bill Gates is a very good leader. So it totally depends on individual tastes, right? But definitely, I think management will only fall into place if you have a robust leadership team, and that's why you see that these days organizations put a lot of time and focus and effort on picking the leadership team. Management is a dynamic activity, meaning so there is no static. Your environment keeps changing, right? Your business environment. I'm sure that in your economics you would have studied about PESTEL, right? That's your political, economical, social, technological, environmental, and legal. So these factors keep changing. So you will always see different cycles of business. You'll always see different factors that influence your business and their outcomes, right? So management is not static. You'll have to constantly evolve to the changing environment, and that's why these days there's a you probably would have heard about VUCA, VUCA, which is volatile, unpredictable, complex, and ambiguous. People have added a F and U there. So VUCA, volatile, uncertain, complex, ambiguous, fear of unknown is the F, and unprecedentedness is the U, right? So basically, I think if I think definitely these two have evolved post COVID, right? Because that was one event which turned the world upside down, and if you look at the geopolitical factors these days, wars all around. There's a war in Europe. Israel attacked Palestine, right, due to an initiative attack that took by Hamas. So that's also unprecedented or unknown in a way, right? So obviously, management has to be adaptable. Now here, I'm sure the Israeli Defense Forces, has to do something unconventional from what they would have been doing all these years to tackle this crisis. It's multidisciplinary, meaning it draws ideas and concepts from various subjects. So, see, because management takes inspiration or from economics, maths, statistics. At the end of the day, see, we're talking about attaining objectives. We're talking about aligning resources, aligning activities, planning, controlling activities to attain objectives and to attain business outcomes. So all these concepts will come into play, whether it's economics, whether it is mathematics, whether it is statistics, all these subjects will come into play. So management draws concepts from all subjects, and that's why it's multidisciplinary. Okay, so it is goal oriented. Obviously, you can't have a company, or you can't have an account or a team which is not goal oriented. So there are clearly laid out objectives, there are clearly laid out goals that need to be attained, and that's one of the primary nature of management. We spoke about levels of management, and this is very commonly used in organizations. I'm sure you would have heard people saying it's the management which decided the policy. Don't ask me, ask the management, right? So in this case, I think people are referring to the hierarchy or the senior most people in the hierarchy, right? So that's levels of management, and that's why you would hear about a matrix, right? Increasingly these days, if you see, one of the competencies that companies are seeking for is the ability to work in a matrix organization. So obviously there are levels levels that make decisions, levels that are accountable for decisions, levels that are accountable for outcomes. Okay, and management need not be owners. Now again, depends what type of a firm are we talking about. Okay, if it's a let's say it's a private setup, it's a small setup. Okay, but management has various definitions basis. So it's not only owners, right? So in a well-run organization or in a professionally run organization, it's not the owners who form the part of the management team. Now let's take the Ambani group. While Dhirubhai Ambani was the chairman, he passed on the mantle to Mukesh Ambani. You see that he's steadily passing on the baton to his kids, right? But there are professionals who manages businesses, right? So there is someone who's at the helm of the telecom business, there's someone who's managing his retail business. So that's a part of his management team. Management is intangible, meaning it cannot be seen, but you cannot touch it or you cannot see it. But how do we excuse me. So basically results can be seen. What can be seen is the results the management attains, right? The outcomes that the management attains. That's very, very tangible, right? But management per se, you can't touch management or you can't see management. Yeah. All right. So we move on to the concept which I said, is basically the art versus science. It's a very old debate yet to be settled. And as I discussed earlier, it is said that management is the oldest of art and youngest of sciences, right? But before we jump into, whether it's an art or a science, I believe that there's no right or wrong answer to this one. It's a combination of both. Okay. Now, so for example, management is a science because of the following, right? It is a science because of universally accepted principles. Now, it's not my principle or your principle. Okay, it's a universally accepted principle. For example, your hierarchy or your matrix environment is followed by all organizations. It's tried and tested by all organizations, right? Experimentation and observation, meaning there have been experiments which have been done. Okay, there have been observations basis methods which have been implemented, which have been tried and tested. So you can validate those results. You can see for yourself. So for example, let's say if my workforce is compensated appropriately, right, as per the skill sets, as per their performance, you will definitely see retention of the workforce. You will see more productivity from the workforce, right? Now this is various types of performance appraisals have been tried and tested, and there are outcomes to validate those methods which have been used, correct? So there is a bell curve, correct? So whenever there's an annual appraisal, there's a bell curve. So bell curve is nothing but classification of your overall performance into buckets, right? And that is basis performance. So that is something which is experimented and validated. Okay. So there is a cause and effect relationship. So there are variables which are interconnected or interdependent for that matter. So one input will lead to the output. So there is a cause and there is an effect. Okay. So if you look at your day-to-day operations, okay, you have a team span and a team structure. So definitely, if you look at it, span of control. Okay, the span of control is nothing but your support ratio. Okay, there's something which is critical, okay, to your performance. Now that is something, if let's say there is the cause is your support ratio is not good enough, okay, you will obviously see a dip in performance of your subsequent subordinate teams. Okay. And most importantly, it is, it's predictable. There are tests of validity, like I mentioned earlier, and certain trends can be predicted based on your validated numbers. So let's say, for example, let me take a very simple example, right? Your attrition trends can be not necessarily 100% accurately predicted, but it can be predicted basis what you have seen in the past months. And if you are able to nail the root causes, you will be able to get a good idea or a good pulse on how the attrition looks like. So these are the reasons because of which management is a science. Now, why is it an art? Okay, so practical knowledge. So practical application of knowledge is very, very important. I mean, I'm sure it's not only me. You also have come across individuals who seem excellent on paper. Okay, they have all the degrees, they have all the qualifications. Okay, they have all the credentials which tick boxes, but they are not able to apply that practical knowledge to their day-to-day operations or to impact their performance. Now, I'll give you a very, very simple example. Sometimes our textbooks also have a lot of jargons, okay, which do not make sense because we are not able to relate to those terms. Now, when I was in my last year of commerce, I kept coming across this word span of control, and I only mucked up, because I wanted to score marks, because that was our education system, correct? But I did not relate to that until I started working, and I started understanding what do you mean by span of control. And the practical application is you look at your span of controls to set the benchmark for your governance and for your performance. So your span of control is nothing but your support ratio, which is very, very important. So you need to know how many managers, how many team leaders, how many senior managers you need to have for a certain operation, right? So practical knowledge of the concepts is extremely important. Personal skills gets very creative, right? Now, obviously every manager is different. Every manager has his or own individual style. Some people, I'm sure you've witnessed in your careers, you've worked with managers who are very energetic, who are performance driven. You have compared managers, and tried to draw parallels between the various styles of working. Some managers may be very process centric and less people centric. There might be managers who are more on the people side and less on the process side. Ultimately, the objective of both the managers is the same, to derive outcomes from a set of individuals to attain organizational objectives, right? Now look at sports itself, right? So Dhoni and Virat are different leaders. So some people like the Dhoni style of leadership, some people like the Virat style of leadership. Okay, so I mean, if you guys, any of you are football fans or follow soccer, or any one of you like Manchester or used to like Manchester United, I would recommend a book called Leading, written by Sir Alex Ferguson, who was the Manchester United coach for 23 years and won a lot of laurels or a lot of achievements for the club. Creativity is another part. So practical knowledge, personal skill, creativity. Now these days, like I said, you hear a lot of jargons, right? So out of the box thinking is one word that comes to my mind. You keep hearing about out of the box thinking. So creative problem solving. So basically your creativity sometimes gives you that edge, because not every problem can be solved in the same typical fashion all the time. And this is not your typical, a rule-based thing, right? You have to have certain level of creativity that needs to be implied, or that needs to be there, right? Okay, so basically, see, again, it is perfection through practice. Again, we spoke about practical knowledge. You also have certain activities. They sound very monotonous, boring, and mundane to all of us. There are a set of activities which we do every single day, but what we don't realize is we have perfected that art or that skill or that craft because we're doing that every single day, right? So people in the IT side of the world can think about stand-up calls, people who are in slightly senior levels, they can think of their stakeholder discussions or their monthly business reviews or their quarterly business reviews. Now this is done time and again. This is done on a daily basis or monthly basis, and that practice would have led to perfection. So if you look at it, it's a blend of both. There is no one way or isolated way to look at management, right? And at the end of the day, I see, who cares whether it's a science or an art? If you are able to choose best of both the worlds and put the principles in place and attain or achieve the objectives that you want to, I think it should not matter whether management is a science or an art. Yeah. Okay. Moving on, scope of management. The scope of management is, again, it's a constantly debated topic. Okay, because I mean, you can keep talking about scope of management, right? But what Harbison and Myers, these are two authors, have tried to restrict it under broad groups, which are economic resource. So the scope of management is economic resource, systems of authority, class or elite. Okay, I'll just quickly read the text a bit to make more sense out of what we just discussed. Just give me a minute, please. Okay, basic business economics classifies the factors, and this is what of production into 4 basic inputs: land, labor, capital, and entrepreneur. Management ensures that using these basic factors of production, it is possible to achieve higher growth trajectory with sustainable profit in the long run. Thus, management itself serves as an economic resource. So the basic idea of management is to utilize resources efficiently and effectively to attain growth. It could be organizational growth, it could be growth in sales, it could be growth in profits, but the basic purpose of business itself is being profitable and sustainable, right? System of authority. Management formalizes a standard set of rules and procedures and need to be adhered by subordinates and ensures their compliance with the rules and regulation. We discussed this earlier also, right? So there is a authority, there is a hierarchy in place, and there are certain rules and regulations which need to be adhered to, which need to be followed by subordinates, and compliance to these rules is a mandate, right? So that is something which is prevalent in all organizations, so, or else it leads to disciplinary action. Class or elite. Okay, so it is considered to be a distinct class that has its own value system. So it's neither classes nor elites. It's a distinct class that has its own value system. Managerial class, often referred to as a collective group of those individuals that perform managerial activities, is essential component of each organization, right? So it's a group of individuals, like we discussed earlier. It's a group which comes together, which puts efforts together, which utilizes resources together, which collaborates, which communicates, and which tries and attains the objectives. Now, this is every organization, right? This is for basically every organization has a management, or every organization has goals or objectives which need to be attained. Okay, management and emerging profession. Okay, again a very debatable topic. Any specialized activity becomes a profession provided it satisfies the following characteristics. Okay, there must be a systemized body of knowledge which is used in either instructing, advising, or guiding others. Your courses has a structure, your courses have a body, right, which decide your training, which govern your training. Okay, there has to be a plan, there has to be a certified body, okay, existence of a formal method and system for teaching and training people with that knowledge and skill. So there has to be a structured, I'm sure you guys have exams which provide you results, which is basically an endorsement that you have cleared a certain exam and you have acquired certain skills and credentials, right? A scope for creating posts of consultants for that skill. Now, obviously, you have a particular discipline, right? But obviously you have certain skill sets that you need to succeed, and you need to have certain jobs created for that skill. Now, let's say if you are a CA, you're a chartered accountant, right? You have that skill, you have that degree. Obviously, there are jobs in the market that are created or that are made for a CA. Okay. Formation of an association by such consultants. So what comes to my NASSCOM comes to my mind, right? So obviously you have a body or an institution which is created by such consultants, okay, or such skill-based individuals. So for example, NASSCOM, like I said, it's an IT body, okay. Existence of a code of conduct among such professional men. So there has to be a code of conduct or a disciplinary or a charter which is supposed to be followed. Readiness to respond to the needs of man. Obviously, and I don't know why it's man, because we're talking about diversity, equity, and inclusiveness. So obviously it should be readiness to respond to the needs of man or woman, right? So we should be able, the profession should be able to cater to the needs of people, should be able to service people. Yeah. So there's a case study in the book. Is management really a profession? Okay, so I would urge you guys to read this. I would also read this. Okay, but I think what will make sense if you have time is basically if the subject interests you, you should go through more details or more articles on this case study, or you should go through case studies for other associated topics. Doctors must take the Hippocratic oath and earn continuing education credit for years. Lawyers must pass the bar and adhere to strict codes about attorney-client privileges. But although managers have been long known colloquially as professionals, colloquially means very loosely, right? The graduate schools of many of them attended have long drifted away from their founding charters, which wanted to create a profession of management. So very interesting one, right? What it says is the very charter due to which an institution was found, okay, so they wanted to create a profession of management based on the above principles that we had discussed, right? But these institutes are drifting away from those principles. Okay, that's the argument made by Rakesh Khurana, a Harvard Business School professor, in his book From Higher Aims to Hired Hands: The Social Transformation of American Business Schools and the Unfulfilled Promise of Management as a Profession. Very interesting topic or very interesting title. From Higher Aims to Hired Hands. So the aim was higher, but now what it says is you're hired by someone because you are a management graduate. Okay, so it's, these days people talk about being a corporate slave, right? So the social transformation of American business schools and the unfulfilled promise of management as a profession. Khurana, who made a name for himself with his 2004 book, Searching for a Corporate Savior, the irrational quest for a charismatic CEOs, is a star at HBS and builds a fascinating argument for why business school education is in need of reform. Okay, so Searching for a Corporate Savior, this is a book, a title, The Irrational Quest for Charismatic CEOs. Flamboyant CEOs, charismatic CEOs, you have Richard Branson, okay, is a star at HBS's Harvard Business School. And this book has a very, that's what Khurana says, a fascinating argument for why business school education is in need of reform or is in need of change, because earlier we read that It is drifting away from the charters, which was the very existence of these management schools. Kurana defines a profession as one in which its practitioners have to master a certain body of knowledge, in which that knowledge is used to help others, and in which there is a governance system that's both ethical and self-policing in nature. Okay, so I think that's why the hypocritical nature example is provided. So he's saying, so you would have heard the term giving it back to the society. So what Kurana is arguing is that apart from possessing knowledge, which is very integral to any profession, a doctor needs to know what he needs to do, a lawyer needs to know what he or she needs to do, right? So basically you need to be able to be servicing to the society or provide service to people, and there has to be a governance system. Okay, but this is where, you know, this is where I think it gets a little tricky, because what he says is that it should be self-policing in nature. Its expectation is that every professional, management professional, should be able to self-police his or own work. That boils down to ethics, meaning I need to be ethical to myself. I need to have a conscience which will enable me to serve the society. None of these really describe management. Anyone can become a manager whether or not they have an MBA. It's not really done to aid a client, and there is no self-policing body making sure ethical standards are met. A very classical argument at the workplace. So anyone can be a manager. So most of our mothers are not MBAs, right? So this is a very classical argument at workplaces, at colleges. You know, why I need to be an MBA? Only if I am an MBA, I'll be a good, successful professional or a very good manager? Not necessarily, right? Okay, Kurana argues that while the founders of today's elite business schools tried to legitimize business education by calling it a profession, no self-respecting elite institution at that time wanted to have anything to do with something so tied to making money. Today it's becoming anything but that. Okay. So the tag around management, right? So you might have heard about the Ivy League schools in the US, the Harvard, Stanfords, Whartons, Booths of the world, right? So they try to capitalize on this degree by calling it a profession, right? By advertising or branding it as a step to success. Okay. Now, going back to his point, these elite institution charters didn't speak about, and that looks like didn't speak about making money. What he's trying to say is today MBA education or management education is all about making money. You just look around in your own cities or in your own towns, the number of MBA colleges that have sprung up, and the number of courses that have sprung up, or the ways and means of providing these education in class. These days you have your online courses. They tie the outcomes to good jobs, to well-paying jobs, bright future. Okay, so it has become very commercialized, and there's a lot of money making in the game, right? Believes we are at an inflection point of what the role of business should be, and as pressures build to create corporations are more attuned to benefiting society, we also need to educate future managers to do the same. He suggests that business schools could have some way of proving their students have mastered the curriculum, a board exam for MBAs, and there should be some evergreen aspect to the MBA, continuing education requirements, for instance. He adds that in Rakesh's normative world, there might even be an equivalent of the Hippocratic Oath for business students. He even has a suggestion for the first sentence: first, I'll not lie. Okay. All right. So, again, he's talking about having that conscience, and there has to be a way where these business students or management students are endorsed or certified. So there's no, so like we have a board exam in 10th and 12th and in graduation, right? So there is no specific universal board exam, or there is no specific exam that certifies all your MBA grads or management students. So he's suggesting one of them. He's also saying that continuous education and evolving knowledge should also be tested, or is also a key for these MBA students. And not necessarily if it works, because doctors also take the Hippocratic Oath. He's suggesting something similar to that for the MBA students also. And interestingly, it says that first sentence should be, first, I'll not lie. So that's Khurana's perspectives, and I don't know how much this Hippocratic Oath will work, because I am not sure if doctors are really have that conscience despite taking that Hippocratic Oath. Okay, it is very important to understand the systems framework in which an organization operates. It is very useful concept for understanding the business operations by identifying the critical subsystems, their interlinkages and interdependence for achievement of common objectives. So exactly that's what we've been discussing, right? So your framework, your organizational framework is extremely important. Now, what is your organization all about? What is its culture? What are its values? Okay, and how are the systems, people, technology, processes, their interdependency and their the linkages are extremely important to see the objectives, how the objectives are attained. All right, moving on. So the key words that we have from this, session is management is an art. Okay, have administration in management. Okay, because you have to plan, you have to organize, you have to manage, you have to control. So it is a function which involves administrative skills. There is a code of conduct, so it is governed by a code of conduct. We did economic resources. We understood that management is goal oriented. Okay, so there are a series of key definitions and words that is there on page 186, but pretty much what we did covered all of these. Okay, so any questions? So this is my first lecture. Any questions anyone has, more than welcome. I think the institute coordinators will share the numbers. Let's have discussions as a group. Let's have a forum where views can be exchanged, opinions can be shared, and if there are updates, they can also be shared. And questions can be posted so that it helps the entire group. Okay, so we moving on from the basic concepts of management, okay, to slightly specific topics. This could be jargons. It might sound, because they are concepts, they are written by accomplished, acknowledged professors, and obviously the concept, apart from being understood, needs to be read, and there has to be references which need to be provided, right? So if there's a particular theory that is not J's theory or that is not ABC's theory, right? It needs to be referenced to a particular author, or it needs to be referenced to a particular management guru. Okay, so we are talking about stewardship theory and agency theory of management. Okay, so you hear a lot about stewardship these days in corporate articles, in your training programs, your senior leaders talking about the theory. It essentially is a form of servant leadership, where you're able to collaborate and align with the stakeholders. Now that's in a nutshell, but we'll have to stick to the context of the topic, and that's why I will read it and explain it in a phased manner. So this theory is developed by Davis, Schurman and Donaldson in 1997, which is based on assumptions of agency theory of self-interested manager rationally maximizing his or her own economic gain. So, and this is what I meant by referencing. was developed by Davis, Schurman and Donaldson in 97. So it is based on the theory of a self-interested manager rationally maximizing his or her own economic gain. So we are talking about managers who would do things to maximize their own personal gains, personal agendas. Okay. However, this individualistic model is associated on the notion of an inbuilt conflict between shareholders and managers. Okay. This problem can only be solved through vigilant monitoring and incentive schemes based around money, promotions, and negative sanctions. Okay. So there is a conflict between shareholders and management or managers. I mean, you would have read a lot of articles where there is pressure from shareholders. There's always a conflict because shareholders constantly expect returns, quarterly returns. They expect dividends. They expect the stock to hit a certain benchmark, right? And this is very closely observed. So basically, and that's the whole concept of stakeholders, right? Of shareholders' expectations and shareholders' satisfaction. So basically, this is done through tight monitoring. And when I say monitoring, what is that monitoring? Because stocks are listed on the Sensex, right? Whether it is BSE or NSE or NASDAQ. So the share prices are being monitored. They're being monitored daily, weekly, right? So the investors expect a certain return. And you would have heard a lot of, especially, your executive compensation linked to the performance of stock, right? Now, surprisingly, if you look at the Amazon stock, still until some time back, Amazon was not even a profit-making organization, but look at its stock price today. Okay. So there are things, there's always this conflict. And see, this is a very general topic. This is an interesting topic also. There are a lot of opportunities, a lot of places where you would have seen that the course of action is different, but what is being done is completely different to satisfy the shareholders. A very simple example is a lot of emphasis is put on green energy these days. Okay, you would have heard about the Paris climate change charter. India has made pledges there. A lot of countries have made pledges by 2030 to make certain changes. But now, if you look at the investments that are required, these are capital investments. Those investments are not definitely made. There is still a lot of dependence on fossil fuels, right? So that's a conflict. So incentives, executive incentives are totally sometimes on your shareholder performance. Okay, but Donaldson opines students of human behavior have been identified much larger range of human motives, including the needs for achievement, responsibility, and recognition, as well as altruism, belief, respect for authority, and the intrinsic motivation of an inherently satisfying task. Stewardship theory is about the principal management relationship. I'll come to that. So extrinsic motivation and intrinsic motivation are the two types of motivation, right? So I mean, if I, on a lighter note, we keep saying about carrots given in the organization. Oh, you'll be promoted, you'll get a good hike. Okay, so it's not only the money, the extrinsic motivation, but there is, for some people, it is also the drive, the fulfillment, the satisfaction that they derive from their work. Okay, now there was a survey, done some years back, and a lot of these organizations which do very well in these surveys on their people practices, they basically do well on 3 questions, and surprising questions, nothing to do with promotion or nothing to do with your annual raises or the monetary incentives, and may not be applicable in the current scenario or in the current environment, and not necessarily applicable to all the organizations. But the first question was, do you have a best friend at work? The second question was, is your work valued? The third question was, does your supervisor give you a pat on your back for a good job done? And I can relate that to this sense of recognition and the sense of satisfaction or the intrinsic motivation. Just because I want to do this, I've never done that. Okay, it's a slightly different challenge. My manager trusts me with this challenge and I need to go ahead with this. Okay, intrinsic motivation of doing a very satisfying task. There are so many teachers in government schools who are still teachers. They are not getting the best of salaries. Yeah, arguably they might get pension after their jobs, after they retire. But again, they are not living a luxurious life, or they are not paid like your private teachers are, right? But these schools, they still run. And the credit goes to a few set of teachers who have taken up the task, because I mean, maybe that's satisfying to them to educate poor kids, to educate underprivileged kids, right? Yeah. So this theory is about the principal-manager relationship. Now, principal could be the owner, principal could be the stakeholder, principal could be the shareholder, right? So it's, and the manager. The manager in this context is management or the individuals who run the organization, right? So stewardship theory is about the principal-manager relationship, meaning the owners, if it's a private firm, the shareholders could be, now let's say Reliance, okay, Mukesh Ambani has a stake, other shareholders also have a stake, right? So it's a blend. It's the Mukesh Ambani is also the founder and the owner. So it could be the owner and the shareholders. Managers in this context is people who run the organization, the professionals who are hired to run the organization. Theory suggests that both parties can choose to behave as stewards of the organization, and that the structural factors can influence the behavioral choice. Okay. Now, this is very aspirational. What it means is both parties can work towards a common goal. Okay. Both parties can align their goals, or both parties can work hand in hand. Okay. If their goals are common, if the objectives are common. Okay. The stewardship theory emphasizes that there is no conflict between managers and owners, that the optimum governance structure allows coordination of the organization to be achieved effectively and efficiently. Now let me take, so it says, the theory implies that there is no conflict between managers and owners. Now let's say Reliance as an example. Okay. So Reliance, there is no conflict between the shareholders, Mukesh Ambani, and the managers who run Reliance. Because the very belief is that there is a governance structure, there is a structure in place, there is a governance structure in place that allows functioning, that allows coordination of the activities which are required to be done. So this implies that that's in place effectively and efficiently. Now there's a very thin difference between effectiveness and efficiency. Efficiency is doing things the right way. Effectiveness is doing the right things. Okay. And the theory authorizes managers to act, since according to this theory, they are not opportunistic or greedy agents, but good stewards who will strive towards protecting and increasing the interests of owners. This is what Donaldson and Davis says. Your stewards or your managers are assumed not to be greedy, or assume that they would not put their own interests ahead of your owners or your shareholders' interests. Okay. Excuse me. Thus, stewardship will strive towards protecting and increase the interest of owners. Thus, stewardship theory views a strong relationship between managers' successful pursuit of objectives of the enterprise and not only the principal's satisfaction. Now, let's say if this is from the owner's context, right? The managers will do things, or will do things which will have the interests of all the stakeholders in mind. Right? Now, who are the stakeholders? Stakeholders is not only the owner. Now, let's say it's the Adani Group. Adani Group, Gautam Adani is the owner, right? But he is not only the stakeholder. So, the theory says that the managers will be aligned in such a way, or they will do things that will not only satisfy Gautam Adani's interests, but also the interests of other stakeholders. Who are the stakeholders? There's a difference between shareholders and stakeholders. I'll come to that. The other stakeholders are the shareholders who have invested in the organization. Government is a stakeholder. Environmentalists, they are stakeholders. The society is a stakeholder, right? So the managers will take action keeping the other stakeholders in mind and not only the owner's interests. That's what the theory assumes. Okay. A steward who successfully improves the performance of the organization generally satisfies most groups, since most stakeholder groups have interests that are well served through increasing organizational wealth. Okay. So definitely, an organization which does well is talked about, right? Now let's look at, you might have heard about SBI in the government space, right? There are certain organizations like SBI, HDFC, Reliance, ICICI. So these organizations, your HPCL, these are the organizations which are generally blue chip companies, right? Even if you look at their stocks, they are known as the blue chip stocks. So what it says here is, now typically if the performance of the company is good, more or less, because you are increasing organizational wealth, that's one way to look at it. More or less you're satisfying all groups or all stakeholders. Yeah, necessarily not the case, because the Adani group was recently in news due to environmental issues. They acquired mines in Australia, right? And their stocks are very profitable. But one set of stakeholders, they're not able to satisfy their interests. It's a different issue. That issue has been taken care of, and that the mine is still there in Australia, right? Yeah. So with this benign view of management, stewardship theory takes a more relaxed view of the need to separate the roles of chairmanship and chief executive, and favors boards having a majority of specialist executive directors rather than a majority of non-specialist independent directors. Very important. So it takes a very benign is kind and gentle view of management, because the assumption is interests are aligned, the managers are not greedy, they are not opportunistic. So there is no thin line. You can have the same chairman and the CEO, right? The chairman and CEO can be the same person, and what it prefers is, it prefers a set of specialist independent directors, right? So people, and this is what increasingly companies are preferring these days, right? People who have expertise in specific fields, because not one person can be an expert everywhere, or you can't just have a 30,000 view or a bird's view of matters which are important to your organization. Now let's say someone should be a compliance expert with so many changes going on in the banking world, right? Someone should be a cybersecurity expert with changes in IT governance and changes in technology, right? Someone should be, let's say, a specialist in labor laws. If you are more into manufacturing and you are more into acquiring mines and establishments, organizations in other countries or in other states. So they prefer someone who's directors who as a collective group, they have their own expertise and they're able to monitor things, keep an outside view and add value. Pearson and Marler argue that leaders' stewardship choice can motivate and facilitate reciprocal stewardship behavior from the employee. Likewise, Edelston suggests that transformational leadership can lead to a stewardship culture. Okay. So, again, if I, as a manager, if my whole way of carrying out things, stewardship is, collaborative, it's like aligning to objectives, keeping stakeholders' expectations in mind, working as a team, that will rub on to the teams also. The teams will reciprocate that behavior if they see their managers doing that. That's what it says. The steward theory states that a steward protects and maximizes shareholders' wealth through firm performance. Very important. The first important point is it's the relationship between the principal and the manager. It protects and maximizes shareholders' wealth through performance. This is the crux of the stewardship theory. Stewards are company executives and managers working for the shareholders, protects and makes profits for the shareholders. The stewards are satisfied and motivated when an organizational success is attained. It stresses on the position of employees or executives to act more autonomously so that shareholders' returns are maximized. The employee takes ownership of their jobs and work at them diligently. Okay, so basically this group, so they could be managers, they could be executive leaders like your CEOs, CXOs, it could be a core leadership team, but they are all working towards the common goal of maximizing shareholders' return and satisfying stakeholders' expectations. Okay, so that's what gives them the satisfaction. If the organization performs well, if the organization grows, the assumption is that gives them the satisfaction. Okay, so they make autonomous decisions, meaning they are empowered to make independent decisions. So, you as a professional can take decisions as long as you have the objectives aligned and as long as your stakeholder expectations are met. And this set of managers is expected to take ownership of their jobs, or I would say ownership of the outcome, and work diligently towards that outcome. So if I am taking a decision, right, let's say if I am saying that I need to launch this new product in this new market, which has never been done, but I want to take the chance. So I am entitled to make that decision, as an executive, but I am also accountable for the outcome. I'm also accountable for the expectations from that action that I'm taking. So there's a diagram on this page, on page 188, which sums up basically the stewardship theory. So it starts with shareholders, okay, empower and trust the professionals or the managers who act as stewards, okay, driven by their intrinsic and extrinsic motivation, external and internal motivation. They protect and maximize, which in turn they protect and maximize shareholders' wealth, and shareholders increase their profits and returns. And it's a circle, it's a vicious circle, it's a circle, right? It's a continuity. So this keeps happening. Okay, we are on page 188. Now we're going to talk about agency theory, the second theory that I spoke about. One was the stewardship theory, which was basically essentially the relationship between the owner and the manager, the principal / owner and the manager, which basically revolves around maximizing shareholders' return and overachieving your stakeholder satisfaction, and which also talks about having a set of individuals who are empowered and who are trusted to do their jobs diligently, aligning the overall objectives and keeping the overall objectives in mind. Okay, agency theory. Since the early part of the 20th century, the corporate sector all over the globe had witnessed a phenomenal rise of joint stock companies, resulting into an increasing tendency of divorce between ownership and management. Okay, so joint stock companies is basically, Reliance is a joint stock company. So if you look at the Indian landscape, a lot of these companies, they were privately found. Look at if you consider Bajaj, Tata, so they were all owner-driven companies, right? Now, when I say joint stock, is basically when you invite participation from your investors, right? You give them ownership. Your stock is nothing but ownership in the organization, correct? So that's what started happening at the turn of the 20th century, and I think it started with the American companies, with the Fords and General Motors. Henry Ford founded Ford, but then it was also listed with the Fords and General Motors of the world, right? It was becoming increasingly infeasible and as well as undesirable to control a large, diversified, geographically dispersed company to be led by a single owner or a group. Let's say Tata, okay, large, diversified conglomerate. It's known as the salt to software organization, correct? It's prevalent in so many countries. It's prevalent in so many industries. So it was. Tata is one example. Reliance is another example from India, right? Similarly, you have examples for organizations in the US and UK and other European countries also. So basically, it was practically infeasible and not recommended, right, to control the entire group by an owner or a group. That is why the necessity of entering into a contract with a professional executive to run day-to-day affairs of the company became imperative for achieving long-term sustainable competitive advantage. So the very purpose of hiring a team or hiring a professional, the existence of contract, employment contract, here I'm referring to an employment contract, is because you need someone who can oversee or who can manage the day-to-day operations, okay, to sustain that competitive advantage. So today maybe I have a competitive advantage, Apple has a competitive advantage, right? So let's say iPhones for example, or let's say any other organization which has a competitive, maybe a software, right? So but it has reached a stage, or it has attained a certain level of goodwill and revenue and profit in the market. Now to sustain that, you need to have the very concept of a contract to hire a professional and run to day-to-day affairs, okay. However, as soon as the separation between the principal, which principal are the owners and shareholders and investors, and agent could be your manager, executive directors, outside directors, be made, the everlasting question that arises in nothing but the conflict of overriding interests of both the parties attached to the company. Now, this is a very classical example, although it doesn't come out so openly, right? You see a lot of executives being abruptly fired these days, especially in the American organization. If you are reading news, you would have heard about Sam Altman, right? The AI CEO, the open source CEO being fired, and he's being reinstated now, correct? Because of the pressure from the employees. 90% of the employees, they signed a petition that Sam Altman, needs to be reinstated. Your OpenAI, I'm speaking about OpenAI, which devised this ChatGPT, right? ChatGPT 3. So increasingly now, because of this arrangement, there will always be a conflict of interest, and there is supposedly a conflict of interest because of this. Sorry, not conflict of interest. There is always this conflict arising from difference in opinion, difference in thinking. It's a constant, right? Because these are owners and shareholders will have a different objective, obviously, which is profit and which is returns, which is increasing stock price, fundamental ones, right? But maybe the directors have a different view, because they want to look at it from a long-term perspective, okay? They wanted to maybe look at things at a 5-year horizon or at a 10-year horizon, right? And not necessarily all the time interests of both these parties are aligned, which lead to a conflict, and that's what it says here. The agency theory, this paradox arising out of the nexus of contracts among individual factors of production, is well known as the agency theory, which was originated from the seminal papers of Alkane and Dempsey, Jensen and Meckling, and later elaborated by the work of Jensen and Farmer. However, some authors pointed out that the agency problem was effectively identified by Adam Smith in his influential book The Wealth of Nations, when he argued that company directors were not likely to be careful with other people's money as their own. For as long as knowledge is power, the superior power is with the agent, said Wilhelm Roscher. Okay, now, so again, the origin of this agency theory, some people say that it was, there are three authors quoted here who have written books in 72, 76. But there is a set of individuals who say that this was originated by Adam Smith, who was the father of economics, in his book, The Wealth of Nations. Now, his counter argument was that obviously, this director thing or this agent thing or this contract thing will not work, because obviously as a director or as a executive director or as a professional, I will not be that careful with the owner's money as I will be careful with my own money. I mean, this is his thought, and so basically what also says is the power is with the agent, not with the principal. The agent is the manager or the executive director or the team that runs the show, okay? and the principal could be the owner, the shareholders, because knowledge is power. As long as knowledge is power, the balance will be always tilted towards the agent, because though they have the knowledge, they have information, they have knowledge, they have access to more information, because they run operations day to day. So they are more in control of the input factors that lead to the outcomes, or they lead to the outputs. Okay. Moreover, as per Jansen and Meckling, the essence of the agency problem is the separation of management and finance. Managers raise funds from investors to employ them into productive and profitable venture, and the financiers need managers to generate a handsome return on their funds. So the agency theory suggests that shareholders are the principals in whose interests the corporation should be run, even though they rely on others for the actual running of the corporation. Okay, so basically, if someone is investing in a business, the person will expect a return. So what it says is that you have to keep the interest of the shareholders in mind, and the fundamental job is to increase the return for the shareholders. Okay. Generally, agency theory problem may be classified into two broad categories: type 1 agency problem and type 2 agency problem. At the heart of the agency theory is the separation of ownership and management, and the problems that arise from this separation. This owner-manager conflict is referred to as type 1 agency problem, right? So this is what we had discussed a while back. So there is a conflict which will arise after separating ownership and management, right? After ownership, you can have conflicts, you can have contradictory views. So this conflicts, that the problems that arise from these conflict or from this separation of responsibility is known as the type 1 agency problem. Okay. Instead of the type 1 owner-manager conflict, the type 2 represents the conflict between majority and minority shareholders. Okay. An example of type 2 agency problem manifests itself in the misalignment of the shareholder goals. I'll come to that. So majority, not necessarily majority and minority shareholders. Majority shareholders could be the family members, could be the owners. The minority, and depends, not necessary. And the minority shareholders are the other shareholders, okay, who are invested in the organization. Could be the other way around also. The owners could have diluted their stakes, so they could be the minority stakeholders. Okay, so now the conflict between the majority and the minority stakeholders is the type 2 agency theory, agency problem rather, right? Because of misalignment of shareholder goals. For example, let's say in a public listed company, let's say let's take Bajaj Group for example, right? So now the goals for, let's say, Rahul Bajaj as the founder or as a chairman, okay, his goals might not be aligned with the goals of the other shareholders, right, who are invested in Bajaj. A classical example maybe, let's say, Rahul Bajaj might want to introduce electric scooters, okay, in let's say Latin American countries, but that would call for a lot of investment and capital expenditure, which maybe the shareholders do not want at this point in time, because obviously that's going to impact your cash flow, that's going to impact your revenue and cash flow, right? So this is an example I'm trying to quote for misalignment of goals between majority and minority shareholders. However, the agency theory had a number of disadvantages regarding the opportunism and self-interest of the agent may act for furtherance of increasing his market value or goodwill, rather than exerting his utmost efforts for enhancement of shareholder value. Okay. Moreover, according to the agency theorists, it was believed that the agent may misuse his power for pecuniary and other advantages, and may not agree to assume risks on behalf of principal interest, because the agent may view these risks as not being appropriate for him to take, because he and the principal may have different attitudes and perception towards the risk profile. Okay, so again, what it says is key. You will have the executives can do things which will increase his or her goodwill or increase his or her personal brand, rather than serving the interests of the of the shareholders, right? Uh, they might do something which would keep them in the good books of the government or in the good books of its employees for that matter. Okay, but it's not aligned to the shareholder expectations. Okay, and that's what it means. And they can also use their power. When you say pecuniary, it's matters related to money. Okay, some things related to money or returns, where they have more information, where they have access to that information, where they get leads about, let's say, share prices. There's an event that they know which might affect or impact the share prices in the coming days. They might misuse that, right? They might misuse that information. For example, I know that a new launch will drive my share price in 3 months. So what I can do is I can have people known to me or people close to me invest in that share and then accrue returns on those shares, because I know that that's going to happen in the coming days, right? And also the attitudes and perception towards risk might be different. Now it could be both ways. Things for the owner, some things might be very risky, but I see it's not that risky, or the other way around. I feel something is very risky, but the owner does not see it as very risky, right? So it has its disadvantages because of difference of opinions, right? So one is maybe I want to increase my personal goodwill. I want to be in the good books of employees. Two, I can misuse power for financial advantages that I want to seek. And three is, the attitude towards risk might be different. Beside the problem of information asymmetry may crop up where the principal and agent may have different level of access to different levels of information, and the former may be in a disadvantageous position since the latter had better proximity to the information. So this is what we had discussed, that different levels of information. The agent in this case will have more information because they are in the thick of action. They run the day-to-day affairs, they manage the routine operations, whereas the principal, the owners or the shareholders, may not have proximity to that information or to that source of information, right? In order to solve excuse me, in order to solve the agency problem, the theorists had suggested an increasing role for the board of directors to perform a transparent and effective surveillance role for ensuring better governance, right? So your board of directors come into play to keep a check, right? And these days you would have heard where board of directors have been sacked if there's a scam which has hit the organization, because ideally there should have been a governance structure in place which should have avoided that scam or that thing that should not have happened. According to Blair, the managers are supposed to be the agents of a corporation's owners, but the former must be monitored, and there should be some outsiders and independent arrangements to provide some checks and balances to make sure that they do not abuse their power. So we are talking about independent boards. Boards are being made more accountable these days for outcomes. So yes, you have agents, you have teams, who work with corporation owners, corporate shareholders, but you also need to have independent, unbiased professionals or board of directors who have or who should put governance measures in place to ensure that there are no malpractices or people don't misuse their powers. Here the costs resulting from managers misusing their position and power, as well as the cost of surveillance, disciplining them to try and prevent abuse, bonding costs incurred by the agent, and reductions in welfare resulting from decisions taken by the agent which are inconsistent with the maximization of principal welfare are known as costs. Okay. So basically, agency costs, there's a cost associated with instilling a board of directors, right? A board of directors, there is a system in place, there is a governance measure in place which incurs cost, right? Uh, there is a cost in the form of penalty or other costs which are incurred if the agents have indulged in malpractices or they were taken wrong steps, and reductions in welfare. I'll come to the welfare point later. Welfare is basically, in simple words, what was the return that the owner or the principal or the shareholders were expecting, and what was the delta in that return because of the wrong actions that were taken, because of the abuse of powers that happened. Okay, that is your difference in the welfare. Okay, the principal welfare. So basically, your cost to put a governance structure in place, the cost incurred, the legal costs and other costs incurred because of the act that the agent has committed, and the difference and the delta is collectively known as the agency cost. Okay. Apart from the ownership management relationship as emphasized, it also covered that the relationship between company. Moreover, agency problem is an important element of contractual view of the firm. The analysis then focuses on infeasibility of drafting complete contracts and the associated complexity arising after. Okay, so it talks about your incomplete contracts, right? Because there are repercussions if a contract is not complete, but you can never have a complete contract, right? Because your contract cannot capture everything. You cannot see 6 months down the line what's going to happen. There are certain clauses you can put in the contract, but then you cannot anticipate each and every detail and then draft a contract by which you can abide a professional, or you can have that professional sign that contract. In the seminal paper by MC Jensen and WH Meckling, agency costs were proposed to be a key tool in evaluating alternative designs of a principal-agent relation. The authors define agency costs, and this is what I was talking about, the detail, as the sum of the monitoring expenditure by the principal, the bonding expenditures by the agent, and the residual loss, that is the monetary equivalent of the reduction in welfare experienced by the principal due to the divergence between the agent's decisions and those decisions which would maximize the welfare of the principal. Okay, so in simple words, like we said, the three costs. So one is the monitoring expenditure, right? So the expenditure which is incurred to put that governance in place, right? So that's your monitoring expenditure by the principal. The bonding expenditure by the agent, right? The expenditure because of the sheer activity or the work or that mistake, caused by the agent. The residual loss, meaning the difference between the expected welfare or return by the principal due to the divergence between the agent's decision and those decisions which would maximize the welfare of the principal. So meaning the difference in return because of the decision which was taken and which was not correct versus the decision which should have been taken to maximize the return. So these three, they constitute the agency cost. However, when agency costs in the sense of, Hart offers three reasons why principals and agents tend to write incomplete contracts. Firstly, so we spoke about contracts. It is difficult for people to think ahead and plan for all contingencies. So it would be literally impossible in maybe 2018 to draft a perfect work at home contract, because we didn't have too many work from home options during that time, right? And we had not experienced COVID. But now you see, I know in my previous organization we had a very well drafted exclusive clauses in our work from home contract, keeping in mind productivity, keeping in mind attrition and all those factors, keeping in mind employee behavior, right? So it is, like I said, it is difficult to plan ahead for all contingencies. It is difficult for the contracting parties to negotiate effectively, especially where no prior experience may be helpful to guide. So putting something in the contract is one aspect. The other aspect is that the contract has to be signed. It's between two parties. So negotiations will not be very easy, right? So that's another piece. Your negotiation need to be effective. It has to be a win-win at the end of the day for both the parties. And thirdly, it is hard for plans to be written down in such a way that an outside authority such as a court will be able to interpret and enforce the contract. Okay, so also in case of a litigation or in case of a dispute, there has to be an external body which should be able to look at this contract and arrive at something constructive and be able to take a decision. Okay. Moreover, Agian and Bolton argue that as a result of contractual incompleteness and wealth constraints, it is not feasible to resolve all potential conflicts between the agent and principal. Okay. So again, contractual incompleteness is a known and a major reason why all issues between the principal and the agent cannot be resolved. However, according to Professor Jensen, the efficient market is the best place to deal with the agency problem. It was believed that an efficient market mechanism will ensure effective corporate control, efficient management of labor, and dissemination of corporate information. SEBI comes to my mind, right? SEBI mandates disclosure of certain information. Now, efficient marketplace is the market, right? So your share price or the way your share moves is a very good indicator of, and that's the belief, how things will fall in place. So you need to have your annual reports is another way of information dissemination, right? Information sharing with your shareholders, which contains information about your sales, about your profit, about your market plans. So the belief was, Jansen believed that the market is the best place because I want to maximize shareholder returns. That's the assumption. The corporate control will fall in place. There will be internal controls because I want to satisfy my shareholders, right? I will have efficient utilization of labor and I'll have transparent, all the information will be transparent. So if you go through the website of any listed organization today, you have the annual reports, you have all the numbers there which talk about the performance of an organization, right? And these annual reports are presented in annual general meetings where the professionals tackle questions, sometimes tough questions. Okay. Consequently, according to Learmount, it will be feasible to ensure that the management will bear the cost of its misconduct and will therefore create the incentives for self-control. So we're talking about penalties now. SEBI's imposed penalty on a few organizations. You have the Competition Practices Act in place. You regularly hear about Google paying fines due to not complying to the GDPR in Europe, right? So the assumption is because they have to bear the cost, and it's also a reputational loss, right? Bear the cost associated with penalties, bear the cost associated with non-compliance to federal laws or compliance laws. This is very common in the banking industry, right? So it is reputational loss. The companies will pay fines and will pay penalties. The assumption is they will manage their own structure and there will be self-control and there will be compliance in place. And that's why you see, especially with banks, there are big compliance teams, there are big audit teams, there is a lot of auditing done internally to take care of adherence to policies or to adherence to norms. It was also commented by Jensen and Meckling that the market was traditionally considered as one of the best places for judging management efficiency, and the joint stock company known for popularizing the concept of separation of ownership and management. Otherwise, millions of the individuals are willing to turn over a significant fraction of their wealth to organizations run by managers of so little interest in their welfare. Okay, so this is what we spoke about, right? So the market is considered one of the best places because the share price, the stock movement, the performance of the company, everything is there, right? The people expect a certain return. The people expect a certain performance of the organization because they are willing to give away a part of their wealth. They're investing their wealth in the organization. They have entrusted their trust in the organization, right? So obviously you will have a watch, people are constantly monitoring the performance because they have invested and they expect a certain return. Moreover, neoclassical economists see the market as the only way to organize efficient contracting, and the firm is viewed as a facilitator of constantly renegotiated contracts. Okay, so some economists say that the market is the only way, the market is the only place, the market is the most efficient way to monitor performance, to monitor contracts. I don't know if you guys have heard about activist investors these days, right? So let's say in the US, it's very common. These activist investors, they have slightly more share than the other shareholders, right? And so they have more say. Okay, and there have been examples where companies have been asked to dismiss CEOs and reinstate another CEO. And this is done by the activist investors based on the information and based on the monitorings that they do. Example that comes to my mind was the previous Uber CEO, Travis Kalanick, was there was pressure on Uber to dismiss him by one of the activist investors because of employee issues that were reported against Travis Kalanick. This is just one example I'm giving you, right? So these economists believe that the market is a only way, the best way, or a very powerful way to manage contracts and to manage performance. So this is a very self-explanatory diagram, right, on page 189, which essentially sums up the agency theory. All right. Moving on. There's a comparison on page 190, which is a one-stop view, and it compares both these theories, sums up rather, right? So theoretical basis for stewardship theories, organizational psychology and sociology. Agency theory is economics, right? So stewardship theory is basically more into satisfying all stakeholder expectations. Okay, it's more collaborative, it's keeping in mind the culture of the organization, it's keeping in mind the interests of all the stakeholders, right? Agency theory is about economics, meaning returns of shareholders. It is solely concerned with the shareholders' returns. Model of man, okay, what sort of a man or a woman or a leader we are looking at in both the theories. Stewardship theory is self-actualizing man, meaning who's self-driven. We came across a few assumptions that under the stewardship theory, the person is assumed not to be greedy and opportunistic and has the stakeholder expectations in mind. In agency theory, we are talking about an economic man or an economic woman, right? Because the sole purpose is shareholder return. Anything and everything you do has to do with shareholder return. Behavior is collective serving, self-serving. Stakeholder satisfaction itself is collective, right? So you're talking about serving the entire stakeholders, your investors, your shareholders, your employees, your communities, your societies. So that's collective stakeholder serving. In agency theory, it is self-serving. You're only serving the shareholders, you're only concerned with returns, you're only concerned with quarterly gains, you're only concerned with half-yearly returns. Motivation for stewardship theory, it's higher level needs, growth, self-actualization needs. Again, we spoke about extrinsic and intrinsic motivation levels, right? In agency theory, it's all about lower level needs, which are basically your materialistic needs, right? Your needs to do with money, your needs to do with your security needs, your needs to do with your physiological needs, right? Okay, it's a very important one. Performance criterion or performance criteria, right? Stakeholder value creation, stewardship theory. This probably distinguishes the both theories. Uh, Stewardship theory talks about stakeholder value creation, meaning value creation for all stakeholders. Okay, keeping all stakeholders in mind before taking a decision. Agency theory is only about shareholder value creation. My quarterly returns, my half yearly returns, my stock price, stock moment, that's shareholder value creation. Okay. Uh, so, owner management relationship, goal alignment is stewardship theory, where it is assumed that goals of the principal and the agent are aligned, and the agent will work towards stakeholder expectations. The agents will work towards maximizing the welfare of the principal shareholders. Here it's a goal conflict. In agent theory, it's a goal conflict. There could be a conflict. The agent and the principal might have different goals, different objectives in mind. Okay. Objective is collectivism. It's a collective serving purpose for stewardship theory. For agency theory, it's individualism, right? So it's all about individual. I mean, it's just the shareholder goal, shareholder return. Here it is about a collective group. It is about a community, a society, an organization, employees. Okay, time frame, long term, very important. Long term and short term. Stewardship theory will always have a long term goal in mind. Now let's talk about your agency theory will always be about return, so it's a short term goal. So you've heard so many articles of probably you would have read so many things about a conflict because of short term and long term returns, right? So for example, investing in renewable energy today may not give you the perfect goal or the perfect return on stock, right? But it's a long-term thing. Now, it's a long-term thing because we are talking about electric cars, we are talking about green energy, we are talking about reducing emissions at the Paris Agreement. Now, considering all these factors, it's a long-term investment, right? So that's there. Very important one. General approach to uncertainty. In stewardship theory, it's based on trust. In agency theory, it's based on distrust. So what's happened is, let's say a uncertain event or an unpredictable event crops up, right? So obviously it will have impact on the share price, it will have impact on performance. So in agency theory, it's distrust, right? People don't trust the decision, or they tend to drift away from the company because they feel that the management was not in control or is not competent enough to take care of certain situations, which in turn may influence the share price in the coming days. But in stewardship, it's more on trust, because ultimately the goals are aligned. The goals are supposed to be aligned. It's an assumption the goals are aligned, right? So there is trust that the management will perform to the best of its abilities. And if you recall some slides back, we said that the management is expected to know its responsibility and work diligently towards them, right? Yeah, I guess pretty much the distinction between theories is found in the behavioral assumptions and structural prescriptions. Okay, stewardship theory describes behavior rooted in a more humanistic model of man. Steward behavior will be based on serving others and therefore will align with principles' interest, right? So the assumption is that, again, I'm summing it up, is that my alignment is my interests are aligned with the interests of my principal, who would be an owner or who could be a shareholder, right? And my entire theory revolves around stakeholder satisfaction and serving others, right? I have to have all the entities satisfied. Okay, that's the structure. That's more humanistic in approach. From a structural perspective, agency theory prescribes governance mechanisms that control and monitor agents in order to thwart opportunistic behavior and better align the goals of the principal and agent. So, single-handedly focused on shareholder value and shareholder return. So, the structure is not on trust, may or may not be, right, but more on governance and controls that prevent opportunistic behaviors, that prevent misuse of power, that prevent decisions which are not good for the organization, right? And basically try and align the goals of the agent to the goals of the shareholders. That's the fundamental difference between agency theory and stewardship theory. Stewardship theory instead prescribes an organizational environment where stewards are trusted and empowered and where control and monitoring mechanisms are not needed because goals of the principal and stewards are already aligned. Both agency and stewardship theories suggest that performance is enhanced by the prescriptions set forth. Agency and stewardship prescriptions and related performance outcomes can be described by the okay. So again, we discussed this because in stewardship theory, the assumption is the goals are already aligned and there is no need for monitoring and control because the management is expected to know its responsibility and they would work diligently towards those responsibilities. Okay, so there is a diagram on page 191. It's agency theory suggests that performance will increase when governance and control mechanisms are in place to monitor and curb the agent's opportunistic behavior. High levels of governance, high levels of performance. So the entire focus is on governance and control. If there's high level of governance and high level of performance, the outcomes will be better. That's what the theory suggests, the agency theory suggests, but may or may not be necessarily true. Otherwise, we would not see so many scams these days, right? But that's a given. You need to have that control and mechanism and that governance mechanism in place. Okay. Stewardship theory, performance increases when the organizational structure is characterized by fewer monitoring and control mechanisms. This type of governance structure empowers and motivates steps to pro-organizational behavior. It is assumed that stewards will feel betrayed and demotivated, and pre-organizational behavior will decrease. So again, self-explanatory in this part because it is assumed that you provide power and trust and decisions would be taken, the right decisions would be taken. In stewardship theory, if you put controls and governance, your loyalty will decrease and your motivation will decrease. That's the whole summation of this paragraph. Okay, we come towards the end of today's module. We've covered the basics of management and we've covered the agency theory and stewardship theory. So I hope that this lecture will add value, will trigger some discussions and debates. And in case if anyone has questions, please feel free to ask those questions and chime in with your inputs and insights on the topic. Looking forward to more such discussions. Thank you very much.